You work hard. It's important to grow your wealth to take care of your family, retire, or be financially independent. But you don't want to take on stocks as a second full-time job. Well, there's a solution. You don't have to spend hours poring over financial sheets. That's why Relentless Growth will go over a lazy portfolio. Portfolios that are designed for minimal work on the investor's part after they're set up. Today, we're focusing on two fund portfolios. Then later, we'll cover the core 4 portfolio. The idea is you set it up and then in a few years when you open it, holy cow, you double your money. Let's begin. Lazy portfolios are designed to perform well in most market conditions in the long run by typically buying just a few low-cost funds, which makes periodic rebalancing easy, but also a step you can frankly afford to skip, in my opinion. Previously, we discussed the most popular lazy portfolio, the 3-fund portfolio linked above. Today, we'll walk you through common 2-fund portfolio designs as well as my own. The 2-fund portfolio is very simple. You only need to buy 2 different ETFs, one broad stock fund and one bond fund, and you have some options in either case. In general, US-oriented portfolios have done better than globally oriented portfolios, and portfolios favoring stocks more than bonds have also done better. The other side of the coin being that the rate of growth of the US economy could slow down, and while the broad stock market generally gets higher returns than bonds, the bond returns are also more certain, even in the case of corporate bonds, so long as the broad fund in this case is decently designed. Here are some sample 2-fund portfolios on the screen that you could set up. Their allocations and an approximation of their past returns. In all cases, we're assuming you do an 80% allocation to stocks and a 20% allocation to the bond fund. Most of the gains and losses are made by stocks, not bonds. So if you are more concerned about losing money, you have a lower risk tolerance, then just put a greater portion of your money in the bond funds. So in the case of a US-based 2-fund portfolio, we use VTI, which tracks all US stocks, and BND, which is a US bond fund, and as a result, for the year 2020, it got a return of 18.3%, and its 10-year average being 11.8%. In the case of the Global 2 Fund, we used VT, which is the Vanguard Fund for tracking all global stocks, and the same BND bond fund. For 2020, it got a lower return of 14.9%, and for its 10-year average, it got the same lower return of 8.3%. Realize when you look at this, past returns aren't a guarantee of future returns, and 2020 was a wild year. These numbers are also approximate. In some cases, the sources may or may not be including dividends being reinvested or accounting for taxes on dividends. They may or may not be taking into account rebalancing. Furthermore, you're an adult and you're responsible for your own choices. You should never invest money that you can't afford to lose. So if you buy these exact stocks today and tomorrow is when the market crash happens, yeah, stuff happens, man. But I wouldn't be telling you about this if I wasn't confident in it. For the hypothetical Relentless Growth 2-fund portfolio, I used my journeyman knowledge level to pick funds without looking at their past performance. I deliberately wanted to target the S&P 500 because I know that it generally gets better returns than total US or global stock markets, and since I have a high risk tolerance and I know that corporate bonds tend to yield higher returns than government bonds, I chose a corporate bond fund. I didn't go through a whole bunch of different bond funds to pick one. I just had a few criteria I wanted to go through. All I thought to myself was, okay, it needs to be corporate, not government, and then I searched the word bond on Robinhood so that some of the corporate bond funds on offer were actively managed and some were dividend focused. Since I don't want to have to pay taxes on any gains, I knew that I didn't want the dividend focused or high yield bond funds, and I also know that passive funds usually beat active funds. At a glance on the app, this left me with LQD. As a result, the Relentless Growth 2-fund portfolio uses VOO to track the US S&P 500 and LQD to track US corporate bond funds. Manually calculating the returns for these two and taking into account their weight in the portfolio of 80 and 20 for the year of 2020, they had a relatively lackluster 12% return, which is less than both the US 2 fund and Global 2 fund, but their 10-year average was 12.3%, which is actually higher than the 2020 return. I show you this so that you can understand that you don't have to be a genius or extremely lucky to be a successful investor. Educate yourself just a little bit, Don't invest money you can't afford to lose, and then just do it, and you will be able to figure it out. For the next video in this series, we'll look at what's called a Core 4 portfolio, and yes, I will also build my own version with my meager knowledge on the matter, and we'll see how it holds up, hopefully further proving to you that you can do this yourself. You only have one life to live. Grow it relentlessly.